Now, we have to talk about a critical dynamic of the oil swap ecosystem. When you think of trading an oil product, of course it makes sense to want to trade the price of the product itself. But if you have a very precise view on a precise location and even specification, trading the outright price is not always the best option. Now let me explain. The outright price of a given refined product or crude is correlated with the core crude futures. This correlation is so strong in some products that you have to accept you are trading something that is influenced by factors that also impact crude as well as your product. For example, if you feel strongly that the diesel market should be very strong in Europe, you rightly will want to trade a European diesel contract. However, the price of this is around 90% correlated at a given time with Brent crude futures, and Brent is a much bigger market. If Brent is weak, the diesel contract will go down even though the local European diesel market that you had your view on is strong. So what do? You can get a more precise reflection of your view with a contract type. This boils down to trading differentials to other markets. So in this example, a good choice would be diesel minus Brent crude. Another option is to trade the time spread, which is the difference between 1 month and the next. This trade is favored by trade houses and majors as it very closely tracks the physical market and isn't influenced nearly as much as other contract types by financial flows. So if your view is based solely on a view on localized physical oil, then the time spread is a great choice. We will go through this in a lot more detail, but the first principle to understand here is that differentials and time spreads give you exposure to a given product in a given location and removes the correlation somewhat to other factors in the oil market you may not have a view on.